$4 trillion. That's how much capital is being poured into AI infrastructure right now. Data centers, substations, power grids. It is the largest infrastructure boom in human history. Bigger than railroads, bigger than fiber optics, bigger than the housing bubble. And just like every infrastructure mania before it, someone's going to go broke building it. The question isn't if it survives, it's who survives when it does. History does not repeat, but it sure as hell rhymes. And right now, it's rhyming louder than any point since 1873. Andrew Ross Sorkin said something this week that I think every infrastructure investor should tattoo on their forearm. Bubbles fund real infrastructure. The investors change, but the assets remain. And he's dead right. And history proves it across 3 centuries. September 18th, 1873, J. Cook and Company, the government's banker, the financier of the Union Army, the primary backer of railroad construction, collapses. One day, America was booming. The next, 25% of railroads bankrupt. 18,000 businesses failed. Unemployment hit 14%. America's first Great Depression. The damage was biblical. But out of that wreckage came the Vanderbilts, the Morgans, the Goulds, names we still know 150 years later. Here's the thing, they didn't build the railroads, they bought them, pennies on the dollar. The railroad builders went broke, the railroad operators got generationally wealthy. Welcome to The Timeless Investor. I'm Arie Van Gemeren, real estate fund manager, student of history, and your host today. And today we're looking at one of the largest infrastructure bubbles in human history, and I'm going to show you exactly how to play it. Because when this $4 trillion AI bubble pops, and it will, someone's going to buy those assets for 30 cents on the dollar or better. The question is, will you be ready to play? Let me give you the numbers that should absolutely terrify you. When you factor in power infrastructure, AI data center spending has reached $4 trillion. That is 13%, maybe 14% of GDP. The dot-com fiber build-out was 4% of GDP. The 2008 housing bubble that nearly destroyed the global economy, 10% of GDP. The post-World War II housing boom, 14% of GDP. The Great American Railroad build-out of the 1890s was 60% of GDP, but that was when GDP was tiny. None of the businesses that exist today, the technologies, the many things, it was mostly an agrarian society at the time, so the comparison is sort of moot. In absolute dollars, adjusted for inflation, we are in one of the biggest infrastructure manias ever. Meta just syndicated $38 billion in project finance debt in 24 hours. OpenAI has committed to $1.4 trillion in infrastructure spending. That is 3 times its current enterprise value. And I don't know its current revenue, but what is it, $13 billion a year? I mean, it's wild. They're even talking now about government backstops. I would forecast we'll see national security arguments. We cannot lose the AI race to China. The US government needs to back it. You know who else got government backing? The railroads in 1873. This is not investing anymore. This is deployment pressure on steroids. And deployment pressure, my friends, is where fortunes go to die. Every infrastructure bubble follows the same pattern. I call it the 4 horsemen of financial apocalypse. In the 1870s, railroads were inevitable. That is phase 1, the inevitable narrative. America was expanding westward. Every banker, every politician agreed, we need more railroads. Today, AI is inevitable. Every Fortune 500 needs AI infrastructure. Every government is racing to build compute. The consensus is absolute. When everyone agrees on something, that's when you should get nervous. Phase 2, easy money. Railroad companies were issued gold-backed bonds with 100-year maturities. Investors were so confident they locked up capital for a century. Today, we're seeing innovative project finance structure, creative accounting, complex debt instruments designed to obscure risk, off-balance sheet financing, you name it. It's all coming out of the woodworks. And when the accounting gets creative, in my opinion, we're in the late innings. Phase 3, the scale trap. This is what kills them every time. Once you raise billions, you have to deploy it. The capital becomes a liability. Railroad companies built roads to nowhere. They overbuilt competitive corridors. They paid peak prices for everything because everyone was building simultaneously. Data centers today, going up everywhere. Companies racing to secure power, paying whatever it takes because we cannot fall behind. Phase 4, the final horseman, the reckoning. For railroads, it was the Bank of England raising rates. Global capital reversed, one collapse triggered another. The trigger this time could be rates, could be a major AI company failing, could be power grid failures. It doesn't matter. What matters is this: the railroads didn't disappear. The infrastructure remained. It just had a new owner. The builders got wiped out. The consolidators got rich. Here's what nobody understands about this particular bubble. It's not about data centers. It's about power. Right now, 1,500 gigawatts of generation sit in interconnection queues. Only 19% will ever get built. The median wait time is over 4 years, up from 2 years a decade ago. In Northern Virginia, the heart of Data Center Alley, Dominion Energy literally stopped new hookups. They hit the wall. No more power. Lead times for transformers, 2 to 3 years. Substations, good luck. Power is not just a cost anymore. Power is the moat. A 1 cent per kilowatt difference equals $4.4 million per year for a 50 megawatt facility. Multiply that across 200 gigawatts of new capacity by 2030. That's an $18 billion annual advantage. Regional costs tell the story. Texas is running at 30 megawatts per hour. Pacific Northwest, 50 megawatts per hour in drought years. Northern Virginia, 35 to 40, and Phoenix, 40 to 45. That is a 60% spread in operating costs for identical computing power. The winners will not be those with the most data centers. The winners will control the power. Andrew Carnegie didn't win because he built bigger steel mills. He won because he controlled the cost inputs, the iron ore mines, the coal, the railroads, the Great Lakes shipping. When competitors needed iron ore, they paid market prices. When Carnegie needed iron ore, he paid himself. Today's version: control power generation, you win. Control grid interconnection, you win. Own substations and transmission, you win. Build another commodity data center, you lose. This is the most important lesson I think we've covered yet on this show. When the railroad boom collapsed, JP Morgan didn't build new tracks. He reorganized bankrupt ones. Vanderbilt didn't pioneer routes. He consolidated existing lines and extracted monopoly profits for 50 years. The Vanderbilts, Morgans, Gould, Stanford, Huntington, they were not the first owners. They were the second, sometimes the third. They bought the wreckage for pennies on the dollar. Then they extracted value from essential infrastructure for the next half century. Some Tier 3 data centers are already repricing below replacement cost. Legacy facilities with perfect infrastructure are being marked down because they lack AI-ready density. The replacement cost, $8 to $12 million per megawatt. Distressed pricing coming, $3 to $4 million per megawatt. That's a 70% discount to build the exact same thing. The fiber optic crash of 2001, 85 to 95% of capacity went dark. $2 trillion evaporated, but the cables remained. Today, Netflix streams on infrastructure that bankrupted its builders. History doesn't just rhyme, it screams, guys. When this $4 trillion bubble pops, one of three things happens. Scenario A, the hyperscalers survive. Amazon, Microsoft, Google consolidate everything. They become the standard oil of compute. Possible, but they're already stretched thin. Scenario B, new robber barons emerge. Private equity and sovereign wealth funds pick up the pieces at 30 cents on the dollar. This is my bet. They have the capital, they have the patience, they love distressed assets. Scenario C, government steps in. Infrastructure becomes too critical to fail. We get quasi-public utilities for compute. The New Deal, but for GPUs. Regardless of which scenario plays out, the playbook remains the same. The second owners will win. So what do you do with this information? First, focus on input control. Don't chase data centers. Back operators who own power generation, grid interconnects, permitted land. The sexy play is compute. The smart play is substations. Second, buy power, not buildings. Utilities, independent power producers, transmission operators, they capture durable economics. Power is essential. Data centers, right now, are commodities. Third, build liquidity now. This boom runs another 12 to 24 months. When the music stops, you want dry powder. Cash isn't trash when assets reprice 70% lower. Fourth, target distress by tier. Skip Tier 3 capital deployment assets. Focus on Tier 1 infrastructure with true moats, location, power, interconnection. These matter when the tides go out. Fifth, think like a robber baron. Don't build during the mania. Consolidate after it breaks. The first owners build the infrastructure. The second owners build the fortunes. We are watching what might be one of the largest infrastructure bubbles in human history. $4 trillion, 13% of GDP. It dwarfs the dot-com. It rivals the railroad mania, and it's going to end the same way every infrastructure bubble ends. The builders will go broke. The infrastructure will remain, and someone, maybe you, maybe me, here at Lombard Equities, will buy it for pennies on the dollar. The railroad builders of 1873 were right about railroads. They just built it at the wrong time. The fiber builders of 1999 were right about the internet. They just built too fast. The AI builders of 2025 are right about computing power, but they are building at peak prices with creative leverage under deployment pressure that guarantees their destruction. Andrew Ross Sorkin was right. Bubbles fund real infrastructure. The investors change, but the assets remain. Don't be a builder in 1873. Be a consolidator in 1880. Don't buy fiber in 1999. Buy dark fiber in 2002. Don't chase AI data centers in 2025. Buy the power and substations in 2028. We're about to see our generation's Vanderbilt emerge from the wreckage. The question is, will you and I be ready? This is the Timeless Investor. I'm Arie Van Gemeren. If you found value in this premium analysis, subscribe to the channel. Check out the premium link below to the Timeless Investor Substack. Lots more data, lots more information for you to digest. Share it with someone you think needs to hear this message. Be prepared. And remember, bubbles don't destroy the infrastructure. They just transfer it from overleveraged optimists to patient opportunists. The second owners always win. Think well, act wisely, build something timeless. Thank you.